Today we're debunking 10 popular myths about the stock market and investing. Remember to like, comment, and subscribe. Contrary to what many people think, you don't need a lot of money to start investing in the stock market. Platforms like Robinhood let you start with just a few dollars by buying fractional shares. This means you can own a piece of a stock even if you can't afford a whole share. Imagine setting aside just $20 a week for investing. It might not seem like much, but with the magic of compound interest, that small weekly investment can grow significantly over time. For example, investing $20 a week at an average annual return of 7% could grow to over $60,000 in 30 years. The idea here is to make consistent contributions over time, which can benefit from the growth of your investments. The main point is that being consistent is more important than starting with a lot of money. Small, regular investments can lead to big gains over time. So, don't let the myth that you need a large sum of money to stop you. Start small, stay consistent, and watch your money grow. Investing isn't just for the rich, it's for anyone who wants to take the first step. Many people think all stock market investments are equally risky, but this isn't true. Blue chip stocks, which are shares in large, well-established companies, are usually more stable than penny stocks. Investing in index funds, or ETFs, can spread your risk across many companies and sectors, reducing the impact if one stock performs poorly. Imagine spreading your investment across hundreds of companies instead of just betting on one. This diversified approach not only lowers risk, but also offers steady growth potential over time. The key is to understand that different investments come with different risk levels. By diversifying your portfolio, you can manage risk better and increase your chances of long-term success. So, don't let the myth that all stock market investing is equally risky hold you back. Diversify your investments to manage risk effectively. Trying to consistently time the stock market for maximum gain is a myth that many investors believe in. Despite common perception, accurately predicting the short-term market movement is incredibly challenging, even for seasoned professionals. Research has demonstrated that missing just a few of the market's best days can significantly impact investment returns. Instead of attempting to time the market, successful investors opt for a long-term approach of regular, consistent investing. This strategy, known as dollar cost averaging, involves investing a fixed amount of money at regular intervals regardless of market conditions. By adhering to this method, investors can take advantage of market fluctuations over time without the stress of trying to predict them. Remember, timing the market for maximum gain is a myth. Focus on a disciplined investment strategy and you'll be on the path to financial success. Contrary to popular belief, relying on hot stock tips is not a reliable way to make money. Chasing trendy tips and short-term market movements can lead to significant losses. True investing success comes from thorough research, understanding a company's fundamentals, and having a long-term strategy. Take the dot-com bubble for instance. Many investors poured money into internet companies based on hype, without understanding the businesses. When the bubble burst, these investors faced huge losses. Successful investors look beyond the hype and focus on long-term value and the potential of businesses. So, don't fall for the myth that following hot stock tips is your ticket to wealth. Stick to informed, strategic, long-term investing for real success. It's a common misconception that higher risk always leads to higher rewards. While higher risk investments can potentially yield substantial returns, they can also result in significant losses. The key is to find the balance that matches your risk tolerance and investment goals. Not all high-risk investments pay off, and some low-risk investments can offer stable, satisfactory returns. For instance, during the 2008 financial crisis, many high-risk mortgage-backed securities led to massive losses for investors, while government bonds, which are considered low risk, provided stable returns during the same period. It's essential to consider risk-adjusted returns, which measure how much return you're getting for the risk you're taking. This concept helps investors understand that sometimes lower risk investments can provide better returns relative to their risk. So, don't buy into the myth that higher risk is always means higher reward. Focus on building a balanced portfolio that aligns with your financial goals and risk tolerance for a more secure investment strategy.